Most Americans are paying experts to invest for them, and 90% still lose to a $3 a year fund they've never heard of. Stay until the end where I answer the 3 most common questions about this. The management illusion. Most Americans believe paying a professional means their money works harder. The data consistently disagrees. Most managed funds underperform the very market they charge you to beat, and most Americans never see the damage until there's no time left to fix it. The fee drain. A 1% annual fee sounds harmless. Over 30 years on a $50,000 portfolio, it removes over $80,000 from your final balance. You are not paying 1%, you are paying $80,000. The complexity trap. Wall Street profits from making investing feel complicated. The more complex it seems, the more necessary the professional appears. Complexity in investing almost always costs more than it returns. The index ignored. An index fund requires no stock picking, no advisor, and charges under 0.05% annually. It has outperformed most professional fund managers over every 20-year period on record. Most Americans have never owned one. The benchmark reality professionals benchmark against the index when they beat it and call it skill. When they don't, they call it a challenging market. That same benchmark costs any American $3 a year. The average American. Most Americans invest through a 401k loaded with high-fee managed funds chosen by their employer. They pay more for worse performance. A lower-cost index fund was always available. They were just never told. The 20-year rule. Over any 20-year period in U.S. market history, 90% of actively managed funds underperform the S&P 500. Not occasionally, consistently. The professional advantage most Americans are paying for does not statistically exist. The simplicity stigma. Most beginners assume simple tools are for people who don't understand investing. The opposite is true. The most financially educated investors choose index funds because they know exactly what they are not paying for. The market return. The market returns what the economy produces. An index fund captures that directly. A managed fund captures it minus fees, minus underperformance probability. The index fund wins before the first trade is made. The wealth gap. Index fund investors build the same market wealth, but keep significantly more at retirement. Every dollar not paid in fees compounded instead. Over 30 years, that gap is often hundreds of thousands of dollars, built by not paying someone. Question number 1. What exactly is an index fund, and how does it actually make money for a beginner? The index definition. An index is a rules-based list of companies. The S&P 500 is the 500 largest publicly traded U.S. companies. An index fund automatically owns a piece of every company on that list. No human decisions required. The passive engine. An index fund makes no investment decisions and hires no analysts. It holds everything on the index in proportion to size and rebalances automatically. The entire engine runs without human judgment. The diversification automatic. One share of an S&P 500 index fund gives you partial ownership in 500 companies at once. No research required. Complete diversification that would take years to build manually in a single transaction. The ETF versus mutual fund. Index funds come as ETFs or mutual funds. Both track the same index with nearly identical results. For most beginners, a low-cost ETF is the simpler starting point. The expense ratio. The Vanguard Total Market Fund charges 0.03% annually. On $10,000, that is $3 per year. A comparable managed fund charges $150 or more. Same market, completely different outcome. The tracking job. An index fund's only job is to match the index, not beat it. If the S&P 500 rises 10%, the fund rises 10%. No surprises, no management decisions, pure market capture. The holdings transparency. Every index fund publishes exactly what it holds and in what proportion. You always know precisely what you own. Most actively managed funds cannot say the same. The dividend collection. Most index funds automatically collect dividends from every company they hold and reinvest them into more shares. When dividends compound alongside price growth, two separate growth engines run inside the same fund. No action required from you. The market cap weight. Most index funds weight holdings by market capitalization. Apple, Microsoft, and Amazon hold more weight because the market prices them as more valuable, not because a manager decided so. The weighting adjusts automatically. The rebalancing reality. When companies are added or removed from an index, the fund adjusts automatically. When a company grows or shrinks, its weighting adjusts automatically. The investor makes zero decisions. There is nothing to manage. Question number 2. Why do index funds consistently beat professional fund managers over time? The active manager problem. Active managers compete against each other. After fees, the average active manager must underperform the market by exactly the fee amount. The competition itself guarantees most of them lose, even if every individual manager is skilled. The SPIVA report. S&P Global SPIVA report tracks active fund performance annually. In 2023, over 88% of large-cap active U.S. funds underperformed the S&P 500 over 15 years. This result has never materially changed in over 20 years of tracking. The survivorship bias. Managed funds that perform badly are quietly closed and merged into better performers before anyone measures the average. The track record of active management looks better than reality because the worst funds disappeared before being counted. The cost certainty. The only guaranteed thing in investing is the cost you pay. At 0.03%, you keep 99.97% of whatever the market returns. At 1%, the manager is guaranteed to get paid before you do, regardless of their performance. The tax efficiency. Index funds trade rarely. Only when the index itself changes. Active funds trade frequently, and every trade in a taxable account creates a potential tax event. Index funds generate dramatically fewer taxable events, a second hidden advantage beyond fees. The emotion removal. Active managers fear during downturns and overbuy at peaks. They are human. Index funds have no emotions. They hold through every market cycle automatically. And that neutrality is worth more than any human judgment over 30 years. The luck versus skill problem. Managers who beat the index in any given year almost never beat it the following year. Past outperformance has virtually no predictive value for future performance. You are paying for a track record that predicts nothing. The Warren Buffett bet. In 2007, Buffett bet $1 million that an S&P 500 index fund would beat a basket of hedge funds over 10 years. The index fund won decisively. The most successful investor alive used his own money to prove the point. The size problem. As active funds grow larger, beating the market gets harder. The fund becomes a significant portion of the market itself. The trades required to generate outperformance create the very market impact that erodes it. Scale defeats the strategy. The long game. Over 1 year, some active funds beat the index. Over 5 years, fewer do. Over 20 years, almost none do consistently. The longer the horizon, the more decisive the index fund advantage. A beginner starting today has more time than anyone else in the market. Question number 3. How does a complete beginner actually buy their first index fund and start today? The account first. The best first account for most beginners is a Roth IRA at Fidelity, Vanguard, or Schwab. All three are free to open, charge no account fees, and offer index funds below 0.05%. This is the only account setup most beginners will ever need. The fund selection. 3 index funds cover nearly every investment need. A U.S. total market fund, an international total market fund, and a U.S. bond fund. Together, they provide exposure to thousands of companies worldwide. 3 purchase decisions. That is the entire portfolio. The 3-fund portfolio. The 3-fund portfolio is widely considered the most efficient complete portfolio a beginner can build. U.S. total market, international total market, bond index. No research, no rebalancing judgment, no financial advisor. Ever. The starting amount. Most major index funds at Fidelity and Schwab have no minimum investment. You can buy a fractional share for as little as $1. The barrier has never been the money. It has always been the decision. And that one is free. The ticker symbol. Every index fund has a ticker, a short code used to find and buy it. VOO is the Vanguard S&P 500 ETF. FZROX is the Fidelity Zero Total Market Fund. Knowing one ticker is the entire knowledge requirement for your first order. The buy order. Buying an index fund ETF works exactly like buying a stock. Search the ticker, enter the dollar amount, confirm. The entire first purchase takes under 5 minutes for anyone with an account already open. The automatic investment. Most brokerage platforms allow recurring automatic investment into any index fund on a set schedule. Choose an amount. Choose weekly, bi-weekly, or monthly. The platform buys automatically. Dollar cost averaging, without any involvement from you. The hold strategy. After buying, the entire strategy is one word: hold. Do not sell during downturns. Do not time the market. The investor who holds through every cycle consistently outperforms the one who reacts to headlines. The reinvestment confirmation. After your first purchase, confirmed dividends are set to automatic reinvestment. Every dividend from hundreds of companies inside your fund reinvests into more shares automatically. A second compounding loop activates with zero action from you. Simple 1. Wall Street built an entire industry on the belief that managing money required expertise and fees. The index fund proved otherwise. Own everything, charge almost nothing, never trade. That rule has outperformed most professionals across every meaningful time period in modern market history.
If you found this helpful, consider subscribing to stay updated with our latest videos.